It's Wealth Building Wednesday, where we answer your money questions with style and grace. To ask your question, go to buildingwealthtogether.com and click Ask JJ or leave a voicemail at 1-833-4-ASK-JJC. Normally, we'd answer questions, but today we've got some wealth building teaching instead.
Hey, y'all. Hey, it's JJ Conway. We're here live at TMEA. That's the Texas Music Educator Association annual conference. And we have been answering money questions all day long. I've got a couple questions in the queue that we're going to do live. And we're hoping that if you have other questions, that you will submit your questions. Everybody who's a member of TMEA that opted in to advertising messages, you have in your box a special TMEA special link that takes you to a place where you can ask your question anonymously. If you're watching me today and you are not a member of TMEA who subscribed to those messages, or if you're listening to me after the fact on the Building Wealth Together podcast, then I want to encourage you to go out to Ask JJC. That's AskJJC.com. And you can also ask your anonymous question there as well. All right. So we've got a couple of questions in the queue. Philip, what question is up first?
First question.
Got to be louder than that. It's loud here. Go ahead.
Our first question.
I'm trying to have a deep voice.
Go ahead.
Okay.
Go ahead.
Way to make fun of me on the.
I'm not making fun of you. I'm so proud of you. You're such a fine young man.
Why is she making fun of my voice?
Because I love you.
All right. Anyway, first question is, what are the different types of retirement plans?
All right. This is a great question to start off with, because when it comes to retirement plans, there's all kinds of different retirement plans. Now, for most of the people who are here at this conference, they are going to be participating in the Texas Teachers Retirement System, TRS. Oh, I just realized I didn't check the acronym, but it's basically the retirement system for the educators. And what happens is they take some out of your pay and they put it into the system. And then when you meet the requirements, you're going to get a pension, right? A pension is something that's really starting to go away, starting to fall out of favor with a lot of companies, because pensions are expensive to maintain and it requires care and detail and protection of a large amount of money to ensure all those pensions can be paid out later. But basically what a pension is, it's the check for life that your grandma, your dad, maybe even your auntie has. I have a pension from the military. I retired from the Air Force after 23 years. I get a check every month for the rest of my life from the Air Force. Sounds like a great deal, right? Pensions are a great deal if you're in a company that still has that. However, there are a lot of pitfalls of doing business and saving for retirement just on a pension. One of those pitfalls is if you don't make the time and requirement gates, then you don't get no money. And so like in the military, it's a 20-year service period. You have to serve for 20 years. Go for it. You have to serve for 20 years, or you have to have had enough of a reserve or guard equivalency in your military time in order to make up the 20 years in order to get your retirement. And so the same kind of thing happens when it comes to the Texas system. They have different programs depending on when you came in. So if you came in early enough, I think it's 1 September 2007, if you come in early enough, you fall under what's called the Rule of 80. And that is your age plus how long you served have to add up to 80, and then you can start collecting your retirement. Now, you could go a little longer and you could collect more retirement, but that's an option to people who were in long enough, or if they were in a little after that, but they had 5 years within a certain window. I don't have the numbers in front of me. I'll look it up here in a second. That's a pension, okay? That's a check for life. The thing about a check for life, like I said, is, now, I don't think the state of Texas is going anywhere. Some people say it might end up being its own country one day, but I don't think the state of Texas is going anywhere by the time you get ready to retire, right? But the thing is if you don't meet the gates and you don't make the money, well, what are your other options for saving? A lot of people think that they're going to get Social Security. Well, Social Security only pays out to people who paid in. So you have to have 10 years or longer working in a job that pays into Social Security on your behalf in order for you to collect Social Security in your older ages. And so if you're feeding into the Texas teachers retirement system, you're not feeding into Social Security. So that's not there for you. So what can you do? Well, you can look at some of these other retirement options. Now, you might have a spouse that has an option 401k at their job. Your district or your school might also have available to you 403b, I think it is, plans, which are usually reserved for nonprofits like hospitals, teachers, things like that. Okay, they might have those options. But all of us who are working and earning a paycheck, we can also set up our own, what they call an IRA. That's an individual retirement arrangement. It's a certain section of the IRS code that says you put your money in here to save for your retirement. That means you're going to be less of a burden on the government later on, and we want you to do that. So we're going to incentivize you to do that by giving you some tax breaks. You can either get tax breaks on putting your money in the first place. So you put your money in and it lowers your tax burden every year. Or I like this. Now this is funny. I remember when this came out. This is how old I am. I remember when this came out, right? And one of my mentors actually didn't trust it. And now it's and he recommended against it. It's actually something I recommend everybody do, called the Roth. The Roth says you put your money into this retirement arrangement, and we're not gonna give you a tax break right now. You got to pay your taxes on that money right now, but we won't make you pay taxes on it later on down the line. And so that's called a Roth IRA. You can set something like that up. All your earnings are tax free. Why are they tax free? Because the government didn't give you a tax break in the short term, so you get to take a tax break in the long term. So it really depends on your expectations. For years, and when I first became a young adult in the workforce, the prevailing theory was, I'm going to take my tax deduction on an IRA now, take a tax deduction on my 401k now, because when I retire, I'm going to have less of an income. I'll be in a lower tax bracket. When I pull that money out of the market, then I won't have to pay as much in taxes. Well, a lot of people are out earning that theory. A lot of people are earning more in their later years. A lot of people are working with financial planners like me who can help you translate your marketable skills into a consulting business that makes more money and allows you to have more fun during your retirement. You know, work on your own schedule, have more control over your life, and they're finding out that they're making way more money. So those are the kinds of situations in which a Roth makes sense. Okay. All right. Another option for retirement, if you feel like you have the time and energy to actually go in and do the research that needs to be done to make this work, is a self-directed IRA where you tell the fund what to do. You can invest in real estate. You can invest in all kinds of things in a self-directed. In fact, I think the only things the IRS says you can't invest in your self-directed IRA are things like gambling, drugs, stuff like that, okay? So those are the different types of retirement plans. And my recommendation for everybody under the sound of my voice is that you participate in your employer plan, and you also develop your own plan. You can go out a great website to help you sort out the different plans that are available to you as a consumer is at clark.com. That's Clark Howard, one of my first money mentors, and somebody whose business I base my business off of. So that's clark.com. All right. Next question.
Our next question is, why would I need to plan for retirement when I have TRS?
Okay. Well, I already kind of covered this a little bit, but just to rehash this question, first of all, if your retirement is wrapped up in TRS, it's a great thing. It's a great value. In fact, I don't know if you know this, but when Ramsey Solutions did a study of self-made millionaires, they found out that the largest category of millionaires, of self-made millionaires in the United States of America, are educators. Yes, people who live on a certain income that you would think that wouldn't end up being millionaires, but because they spend less than they make and have solid investment for themselves, now they have been able to retire very comfortably. So I was really encouraged to hear that, okay? But if you're a part of TRS, like I mentioned in the other retirement options thing, your school district is not paying into Social Security. So you don't have that additional added value of Social Security, okay? The only retirement you can expect is TRS, and that's if you meet the requirements. You know, let's be real about that, okay? Let's be real about that. You have no idea what is going to happen in your life in the next 10 to 20 years, all right? You could fall in love with somebody you met at this conference today, and then you want to follow them into the missions field, or maybe one of your parents is in another state, And 5 or 10 years from now, they're getting older. They had you in their old age, and now you want to go home and take care of them. And you're not here. In order to give yourself the maximum amount of opportunities to be able to do what you want to do with your life, your time, and your resources in your older age, it's important to invest now in vehicles that will give you that flexibility and that freedom. And so when we think about how do we build financial freedom, well, that's very, very simple. It's simple, but it's not easy. And I say that because it's very, very simple, but it's not easy. And that's why a lot of people don't do it. The secret to building wealth is to spend less than you make and invest the rest. And I'm not talking about investing in a fine handbag or investing in a nice car or investing in a fur or investing in a rug from the Middle East. Okay, those things could be considered investments if you do the research to buy them at dealer rates and then sell them later. But generally speaking, those are things that lose value as soon as you buy that new car. It is losing value once you drop it off the lot. In fact, once you drive it off the lot. In fact, one time I was looking for, when I bought the original RAV, the first RAV. Look, I'm a RAV connoisseur now. When I bought the first RAV, I was looking at another vehicle that I'm not going to name. And the dealer was offering $10,000 off this $30,000 car as an incentive to try to move them because it was at the end of the year. Well, guess what? I knew that as soon as I drove that brand new car off the lot, it immediately lost $10,000 worth of value. The dealer wasn't doing me a favor. The dealer was simply giving me the discount that I would have ended up having, the hit that I would have had to take had I took it off the market and if I took it off the lot and then had to come back and return it. That's all the dealer was doing, okay? They weren't giving me a big blessing, all right? Whereas the RAV, when I bought it, man, that RAV held its value for a long time, all right? And so we have to understand what it takes to build wealth is not what everybody else does. Generally speaking, everything that everybody else does, guess what that does? It loses you money. That's why everybody's so broke, okay? And too many of us have spent too long taking advice from our broke friends about how to manage money. Gabriel, my child is doing cartwheels in the middle of the walkway. Come on over here. Come on over here. Come here and play your town. Okay? Come here and play your town. Sorry about that, y'all. Okay. All right. I think we got that question pretty good. All right. Next question.
Next question.
You gotta be loud. They gotta be able to hear you.
How can I get my wife on the same financial page? She spends too much.
Oh, well, I hope you're not gonna ever have this problem. A, because you're gonna wait a while before you take a wife, and B, because you're gonna find somebody who knows how to handle money or is open to learning how to handle money. Like, as in, comes to your mama's classes. Like, that's a good sign, right? Look, I think that should be a gate. He should probably pick somebody that's willing to come to mama's classes and help her out.
I'll ask her.
Whoa. Let's back that up because we're not talking about marrying anybody right now. We haven't even gotten to the mama allowing a date phase yet. Look. What did he say the other day? You said the parents of the girls I'm interested in, they're more scared of you than I am. I'm not scary. I'm not scary. I'm nice. I love everybody. But I worked hard to get this child a better life. And you know what? Nobody's going to come along and tear it down. Not on my watch. Okay, let's get back to the question at hand here. Okay, how can I get my wife on the same financial page? She spends too much. Okay, first of all, let me answer this question with an observation about life. Most of us can hardly control ourselves, let alone make another person do what we want them to do. I mean, I want you to think about this in real life. Most of you listening to me today, you told yourself that this morning you were going to get up early, you were going to go work out, you were going to go have a healthy breakfast, and you were going to start the day off with big wins so you could kick butt and take names, right? That's what you said you were going to do. But what did you really do? Most of you hit snooze about 2 or 3 or 4 or 50 times, right? So by the time you finally rolled out of bed, you didn't have time to work out. You certainly didn't have time to press your juice or make a healthy breakfast. So you didn't eat healthy. You didn't work out. You're barely dragging along after your third or fourth cup of coffee today, right? You didn't plan a lunch, so now now it's the afternoon and you are dragging. So you get some candy. You come by my table and you get some candy, and you're trying to go. You're no better than your wife. You are no better than your wife. It's just a lack of discipline in a different area. So I just want to point out that it's the same thing. We lie to ourselves all day long. But see, we judge other people by their results. We judge ourselves by our good intentions. Well, I intended to do this with my money. I intended to do this with my time. I intended to do this with XYZ. But we judge our spouse, we judge our friends, we judge our clients, we judge our coworkers by the results they have. Well, they didn't do what they're supposed to do. All right. So I just wanted to point that out. Just wanted to point that out. And I'm going to recommend that if you're in the situation where your spouse is not on board with your money goals, why don't we start with keeping our side of the street clean? Let's start with keeping our side of the street clean. And let's start by living by our own principles that we want our spouse, our friends, our coworkers to live by. See, we might have our money act together, but perhaps we are undisciplined in another area of our lives, and that's spilling over into our treatment of others, or we're condescending to others because we're good in this area, but we're not good in that area, okay? So why don't you live by these principles with money and health and relationships, and see if that doesn't soften the heart of your wife? See if that doesn't soften the heart of your wife to be able to achieve the goals that you want to achieve, to be able to be a partner with you, and to be desiring to help you get where you want to go. That would actually be my first actual recommendation. Like if this couple came in and sat down with me, the first thing that I would want them to do is to dream a little bit about what they want in the future. Dream about what a life without debt would look like. Dream about how much more fun you could have out of life if you weren't making so many payments, if you didn't have so many car loans and credit card bills and college loans. Dream about what that would look like, and dream about what it would be like 10 years from now. If you had the money to buy a second home, or if you could take vacations without racking up more debt, or if you could give a good Christmas to your family without having to stress out about those bills that are coming in January. That's actually where I would recommend a couple start. And the reason I didn't start off with that today is because, the way that this was written kind of makes me think that this couple hasn't been together as partners for a long time. And it actually, the way it was written, makes me feel like perhaps you looking down on your wife for not doing what you want with the money. And as the women's wealth mentor, right? As the person who helps women of all ages learn how to manage money and grow their wealth, know is that have to your wife, the less willing she is to help you get what you want to get. Okay, looks like we're back. Okay, we're back. Good, 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 good. All right, all right. Let's go back to that question. So when we got cut off, I don't know how much you all heard, but when we got cut off, we had somebody who asked a question about how to get their wife on board with their money goals. They said their wife spends too much. And I understand from a provider perspective because I was in the military for 23 years and I remember being that person that made all this money and my ex-husband spent it faster than I could make it, right? So I get that. However, let me tell you something about the difference between men and women. And I am not a behavioral scientist. I am not a psychologist. I don't play one on TV. But one thing I know as the Women's Wealth Mentor who helps women learn how to build wealth for themselves and their families, one thing I have learned that generally speaking, a woman wants to support her man. So if she is spending like crazy and you are at cross purposes for the goals, chances are, and again, I could be wrong, I could be reading more into this question than while it was written. You really can't tell tone from how something was written, but I suspect that the more resentment you show towards your wife and her spending habits, the less likely she is going to be to ever get on board with what it is you want to do. So in this situation, you have got to find a way to come together. You have to find a way to come together. But if there's a lot of resentment, if there's a lot of bitterness, if there's a lot of consternation there, if y'all been at loggerheads and fighting, you mad at her for buying $5 at the 5 and below, and she's mad at you because you bought a boat last year. See, y'all are never going to get forward. You have to come together. You have to dream together and say, this is what we want for our future goal. This is what we want for our family. This is what we want in order to have the life we desire to have. And then once we have the goal together, now here are all the little trickle down things that have to happen. We don't buy a boat without telling our wife and then get mad at her for buying a new dress. Okay? So even if the things you want your wife to do on paper are the right things to help you build wealth, and what did we say was the key to building wealth? Spend less than you make and invest the rest, right? Even if the things you want your wife to do are exactly what should be done in order to build wealth, if you all can't get on the same page of the air of mutual respect, then it's never gonna work. Now that I am retired from the Air Force and I am playing the role of stay-at-home mom, I have this international business, right? But for the most part, I am a kept woman. I remember, I'll never forget when early in our marriage and my husband was like, well, if you want to be a stay-at-home mom, I can make that happen. And I didn't even believe it because there were so few women in the military who actually are able to make that transition. Usually when we retire from the military, we're so steeped in debt and we're so steeped in bills and we have so many commitments that we can't afford to stop working. That's how I know this stuff works, y'all. That's how I know this stuff works. But one of the things that happens in that transition is if you are not a partnership, it is very, very easy to look at your wife as a parasite instead of a partner. Now, I'm not saying whoever put this question in is having that problem. I'm just saying from somebody who's been helping people get out of debt and build wealth for about 20 years now, even while I was in the Air Force, that tends to be the sentiment behind a question like this. I'm working hard and I'm doing this and I'm doing that, and my wife is just spending the money and she's not really contributing. Honey, your wife is contributing. If she's taking care of the kids and she's managing the home and she's making sure the meals are healthy and she's managing well what you've got, then she is contributing. And it's time to give some respect. I'm telling you today, a little bit of respect goes a long way. A little bit of respect goes a long way, okay? Don't get mad. Don't get mad at me. Don't get mad at me, because you know what? I find that guys are more like that than women are. Oh, well, she don't want this and this. I'm just gonna be egotistic and I'm not gonna support. I find that men are more like that than women are. But if you've been disrespectful to your wife, it's gonna be very, very hard to get her on board with your financial goals. So have a mutual partnership. Look at each other as partners. And what does the Bible say? Heirs together in the partnership of life and the grace of life, right? And find a common dream that you all can aspire to, and then really sit down and dream together about the life that you want to live, and then go about establishing that life together. Okay, I said I wasn't a counselor. I said I wasn't a behavioral scientist. I am not a marriage counselor. I'm not a therapist. I'm none of those things. But one thing I do know is that a lot of couples, I'm doing my thing, they're doing their thing, and we grow apart. We have to make the choice to grow together, and that's a choice. It's a choice every day when I have choices in what I do with my time, what I do with my money, what I do with my energy. I can make a choice that's going to take me further away from my husband, or I can make a choice that's going to take me closer to him. Okay? And so if I make these choices, we think that life is just happening, but really what's happening is we are making choices to grow apart. We are making choices that pull us apart. We're making choices that force us apart. And then 20 years down the line, we're looking at each other like, well, you're not the person I married. No, we're not supposed to be the person that somebody married. I mean, if 20 years from now, my husband is not supposed to be the same person I married, and I'm not supposed to be the same person he married. I know he's hoping I look as good as I did when he married me, and I know I'm hoping he's as nice to me as he was when we first married, but we're not supposed to be the same person. We're supposed to be mature. And the problem is we look at that separation and we look at these lack of choices to grow us together, and we find that money is the symptom of the growing apart. All right. So these are really, it's really more of a marriage thing. And sometimes it's an education thing. And one partner knows more about money than the other partner. And then the way they try to force things on the partner who knows less about money is disrespectful and condescending. That's usually what happens when I get this kind of question. All right. I think we better move on to another question. What's our next question?
I taught in Ohio for a couple of years and have money in the state teachers retirement system of Ohio. Can I transfer that to Texas TRS?
Great question. Great question. Okay, so I don't have the exact specifics on Ohio, and although I've been living in Texas for the last 2 years, I'm still learning TRS. Okay, so I'm going to be upfront about that. This is not something I have expertise in the actual fine print and the actual numbers and things like that. But what I do know is the broad overarching concept that you can be armed with when you go ask the people who are more experts in the fine points of each system. Okay. When you move from one retirement system to the other, whether it's corporate, whether it's educators, whether it's whatever it is, fill in the blank. Other than military, although I do believe that military, if you go from one service to another, there's a similar rollover program, right? Typically, there's several options of what you can do with that money. One option is to just pull it all out. If you've been in long enough to be vested, you can pull that money out. I don't generally recommend that because that option usually comes with a pretty big tax hit. And I like you to keep your money, not throw it away in an impulsive decision, right? Some states do cooperate with each other. Their educator and teacher retirement systems communicate with each other. And so you can move the money from one system to another. That allows you to roll it in. You don't take the money, so you don't have the tax burden. One system sends it to the other. It's the same in the corporate world. Some ways that you can do things, depending on the company and the plan that they establish, they take the money directly from one and roll into the other. You don't touch it. You don't get to pay the taxes. It's a blessing, right? Some states have a lighter form of cooperation where it's not an easy rollover, but they allow you to buy back your years. They allow you to buy back your years from the one state's retirement system, one for one, into the new state's retirement system. Okay, and so some states it'll be a 2-for-1, and then some states don't do anything, and you basically got to come out of pocket. You got to show the documentation that you taught, but then there's a fee for each year that you want to buy into the new system, okay? And so the first thing you've got to do is you got to contact Ohio and find out what your options are and what you can do with that money. Some states will allow you to just leave it there, and then when you hit retirement age, you pull it out. Some states have rules of 80, rules of 90, rules of 100, or whatever it is that they use the rules of, where you wouldn't be able to access that money. So we really don't know where you stand until you contact the old employer and find out what your options are. Because even if you can roll that money over into TRS, that may not be what you want to do. If you were in TRS before 1 September 2007, or if you had 5 years, I think it's 5 years of service up till 2014. So maybe you came in after 2007, but between 2007 and 2014, you had at least 5 years, then you could still fall under the old rule of 80. But if you came in, say, January 2015, well, actually, this is 23, so that might be long enough. But let's say you came in 5 years ago, 4 years ago. You're not even vested really yet, and you have 10 years in another school district. Well, if you're not planning on teaching here for the long haul, that may not be worth it. But as a financial planner, I can't even tell you if it's worth it till I know what the old state says and what your new program says. So you got to go with your old state and get the documentation that you originally signed up under, and the documentation and how your plan has changed over time. Because a lot of it's basically whatever you signed up for, that's what you get. All right. Okay. So next question. What's the next question?
My district offers index life insurance. Is this a good idea?
Okay, so index life insurance. So the question was, my district offers index life insurance. Is this a good deal? Okay, and oops, let me fix that. Now this is funny because I actually was just talking with somebody about insurance, and so I put together a little slideshow on insurance. So if you are watching me as part of TMEA, if you're part of the Texas TMEA registrants that opted in to marketing messages and you got the link for this to watch the replay, then that's one group of people. But if you're listening to this as part of the Building Wealth Together podcast and you're just listening audio, then I want you to go to my YouTube channel, to my Facebook channel, to Instagram. No, it's not on Instagram. LinkedIn, wherever it is that these videos port to. JJ knows the way. And I want you to look with your eyes what I'm about to show you. I'm going to try to talk through it the best as I can for those who are only listening to as part of the podcast. But I also really want you to be able to see what I'm about to show you. So when it comes to insurance, there are different kinds of insurance, okay? The one that most people know about is term life insurance. Term life insurance is basically, what does it cost to insure you? It's based on how old you are. It's based on your medical conditions. It's based on a couple of factors like that. And there are people who their entire job, y'all, their entire job is to calculate these actuarial tables that tell insurance companies the risk that they're taking on insuring you. So they know down to the average penny. When they insure JJ Conway today, this is about how much it costs in order to break even. If they were to wait for 5 more years, this is how much it would cost for them to break even, okay? So they can calculate that, and they make good money helping the insurance companies understand how to calculate that, okay? And so what you're going to find is your term life insurance is going to be some of the cheapest life insurance that you're ever going to find as an individual. Now there's another kind of group of term life insurance. It's called group life insurance, and that's when your employer can negotiate even better rates than you getting term life insurance, because your employer can go and say, hey insurance company, I've got 100 people that need insurance, and we're going to insure them for as long as they work for us, and we're going to pay for it. When they might charge you some. I know the Air Force used to charge me like $20 a month or something like that for our group life insurance. It was a $400 policy, and as long as I was still active duty, that policy was in effect. If I passed away, not only would my son or his caretaker at the time, because I had gotten divorced and I was a single mom at the time, not only would his caretaker have gotten the insurance policy that I took out on my own self, but they would have also gotten the extra $400,000 of group life insurance from the Air Force. But the minute I retired from the Air Force, the minute you leave that employer, that insurance disappears. It's not a part of your life anymore. Now they do give you options, but I think my option was I could convert that to veterans group life insurance for like $900 a month. I was like, forget that. I could do better to invest my money for $900 a month and leave that to my son. So that's one type of insurance. That's term insurance. And so what you see in the chart that I have here, for those of you who are on the podcast, you don't see the chart, but I'm going to try to talk through it. What I'm showing right now is a chart that shows, now this is an example. This comes from Fox Business. I did not generate this chart. This is a couple years old, but it's just showing the example of how old you are and how much it costs to insure you. The reason it costs what it costs to insure you when you're older than when you're younger is because you're more likely to pass away when you're older, okay? You're more likely to have complicating medical conditions. You're more likely to have these other issues. So if I'm going to pay your family money when you pass away, well, I want to make sure that I don't lose money. See, the insurance companies are not a nonprofit. They want to make money. They want to pay their employees and they want to make money. They want to do what they got to do in the world and they want to make money, okay? They want to make money. You're going to find some cooperative ones, insurance companies or cost sharing that might not, but that's outside the scope of what we're talking about today. For the most part, a company wants to make sure that they don't lose money, okay? And so how much is it going to cost? If I insure 100 people who are 55, this is, and I see here at the 55 point, it's about $225 a month for term. Wow, that's really an old chart because I think it's more than that now. That's way more than that. This is 750 20-year term. Okay, with non-smokers with a really good health, who are really good and really healthy. Okay, so if you're really good and really healthy at 55, then you probably will live to like 80 or so, right? But what they're trying to do is make sure that they're not going to lose money. Now, there are other types of insurance programs. Okay, this is just the basic cost of insurance. That's how much it costs to insure you. And of course, the company's going to build into that cost their administrative cost, their profit cost. They're going to build that into the cost of insuring you, right? And that's just an example, okay? I don't want you to get hung up on the numbers. I want you to get hung up on the shape of the graph, how it goes up more as you get older, right? But there are other kinds of insurance policies out there that give you that you pay more for, but they take the money that you're paying more for and they do different things with it that result in investments or the buildup of cash value. So let me go to the next chart on that, okay? The next chart on that shows an example of different kinds of insurance policies and how the funds are calculated, how the premiums are calculated, what you pay every month, how that's calculated, okay? So there's the cost of insuring you. That's that term thing, okay? It goes up all your life, right? But they do an average. They calculate an average for how long you're expected to live, right? They're going to charge you for that. They're going to charge you for any administrative expenses that they're going to have to run that plane. They're going to charge you for anything that they're going to use to invest. And what these other plans do is they take your extra money over what it costs to insure you and they invest it in the market. Well, why are they going to do that? Well, because as you get older, it costs more to insure you. But if they try to sell you hey, you're going to pay $20 a month now, you're going to pay us $22,000 a month later, well, people probably aren't going to buy that. So they set a high enough fee that they know they can invest this and that they can then outpace the market. Okay, they know that they can outpace your costs by investing in the market. And so what you'll find in a lot of these programs is you will find that they say, oh, don't worry, you're not going to lose money. We're going to always give you some kind of, we're going to make sure that you don't lose anything. Well, the reason they can make sure you don't lose anything because they have already calculated out, they've done the actuarial tables to know what it's going to cost to insure you. They charge you a little bit more to make sure they have room to invest, and then they go and invest in the market at rates that they know will outpace the growth in what it costs to insure you. So if I had the chart where I originally showed you of the cost of term life insurance, and I could draw another line, let me see if this will let me do that. Will this let me do that? Well, let me annotate it. Let me see if this will let me annotate it. Screen, laser pointer, pen, highlighter, pen. Okay, here we go. What they do is they charge you more. Let me undo that. Let me undo that. Okay, what they do is they charge you more every month, okay? Because they know in this space right here, they're going to invest it. Okay, they're going to invest all that money. They're going to invest all that extra money so that when your cost of, if you live a long time and the cost of insuring you is more than what you're currently paying, they still have all of this investment throwing off passive income. Throwing up passive income. Okay, I don't know why that's not letting me do that. I'm trying to type passive and it's just not working. But they know that this is covered. This section over here. Over here. Whoa. Okay, something's wrong with my thing. Let me try it this way. let me try that. This part here is overcome with the earnings from this part over here. Well, look at the difference in this. Okay, and y'all know now. If you've been on my channel for any amount of time, then you know the concept of compound interest. They are investing and making buku bucks off of you over here. They're making big money. This over here is nothing to them. The amount that they have to cover when the cost of insuring you is more than what it costs, what you're paying every month is nothing, because they made so much money off of this space where you're paying more. Okay, and so there's a lot of different breaks. I realize that the final drawing of that looks really kind of wonky, but there's a lot of different breaks that they give you. So what are some things that they do? They say, oh, guess what? We're going to let you have a tax-free loan when you get older. Yes, we are. We're going to let you have a tax-free loan. And so you can pull some of that money out and you can put it back and you don't have to pay taxes on it. Why don't you have to pay taxes on it? Because guess what? We don't pay taxes on loans because you got to pay them back, right? But check this out, okay? In this situation, they have invested your money, and when you die, all they pay you is the policy of the life insurance. They get to keep all that big amount that was invested all those earlier years. So what I might suggest to anybody who's looking to get insurance is that unless you have some extenuating circumstances, unless you have a special needs child and you can't afford for your life insurance to run out like a term policy does. Term only lasts a certain amount of time, 20 years, 30 years, 10 years, 40 years, whatever you buy it for, right? But this other type of insurance that we've been talking about, this index life, this universal life, variable life, they're all different names for the same style. They all do different things with the same style of insurance that I've drawn out for you here. Well, if you don't have an extenuating circumstance where you always need insurance for the rest of your life, like you would with a special needs situation, well, I might suggest to you that you be your own bank, that you get the term policy and you invest the difference so that you are making this money, so that you are making this spread. Oops. So that you're making this, okay? So that this is yours and not theirs, okay? That's what I'm going to recommend that most of us do. Now, if you are a high net worth person, we can take $1 million and we can put in a nice insurance policy that meets that falls along these guidelines, and we can turn that 1 million to 7 million like that, right? We can do that. You're gonna pay a little bit of taxes on it, but ultimately it's gonna be a nice policy. It's gonna set your family up, your future generations up, leave something to your children, your children's children. You got a special needs child, well, you can't afford for 20 years from now for your life insurance policy to run out, and you can't just say I'm gonna build up in the market and after I've built up a couple $1 million, now I'm going to leave all that to my kid. You might could do that, but you would have to do it in a certain way so they don't lose their benefits, their special needs benefits, their disability benefits. You put them in a special needs trust or you do something like that. But since most of us don't know when we're dying, and most of us don't have a couple million sitting in the bank, most of us who have that situation, we would want to consider this type of insurance. I personally like to get all of my clients to a place where they have enough invested that they don't need this, okay? Because you can see that when you pass away, the company, let me put that chart back up. When you pass away, that company, they get all that money. They pay your family a little tiny bit and they get all that big stuff, all right? So those are the different types of insurance. Now, the question was not this, but since I already had the charts built, I figured we would go and do an overview of insurance, right? The question is saying, is this a good deal? Well, the answer is, guess what the answer is? The answer is it depends. It depends on your health. It depends on your time horizon. It depends on your family situations. It depends on a whole lot of things. I have just shown you why in 999 or cases out of 1,000 why this insurance policy wouldn't be a good deal for you. But there's always that one exception, and we can sit down and talk about it with a free consult that you can get at jjclink.com/TMEA. That's jjclink.com/TMEA. If you need any more details on the things we've talked about today, I want you to go out to jjclink.com/TMEA and get your free, it's worth $99 financial tune-up that you will be able to sit down and we'll be able to talk through these questions specifically for your situation and analyze all the other factors that your TV commercials and your broke friends aren't thinking about when they're giving you money advice. All right, I think that's all the questions for today. Is that all the questions we have for today? Okay, all right. Well, I want to thank you all for being on with us live. And if you're listening to this after the fact as part of the Building Wealth Together podcast, or if you're listening to this after the fact as a replay from the TMEA e-blast that I'm going to send out tomorrow, I want to encourage you to join me live every Thursday night, 8:30 Central, 9:30 Eastern, where we answer your money questions with style and grace. Every first Thursday is Fireside Chat. That means ask me whatever you want to ask. I should probably change it to AMA because that's what the new generation says, right? But our every second Thursday is about six-figure business building, where we answer how do you take the talents and skills that you have and create multiple streams of income so that in your later years, you're not slaving away to a job or not stuck in a toxic environment, but you're able to create the life that you want to create. You'll be able to create your life by design, not default. Every third Thursday is our Real Estate Thursday, and we talk about real estate investing. This month's real estate investing class is going to be on Wholesaling 101. If you're listening to this after the fact, we might be covering private lending. We might be covering subject to. We might be covering creative financing. We might be covering driving for dollars. We might be covering, what else do we cover? We cover note buying. We cover tax sales. We cover landlording. We cover foreclosure consulting. We cover all these different things to help you get more out of your life and keep more of your money in your pocket. Our every fourth Thursday is our Empowered Entrepreneur, and that's where we look at how we can grow into the person we need to be to do, have, and experience the greater impact, the higher levels of significance that we are desiring to have. I'm JJ Conway, and again, I want to thank you for being here with us at our special TMEA broadcast. I hope that I'll see you Thursday nights, and I also hope I'll see you on the Building Wealth Together podcast. You can find that on iTunes, Spotify, Ghana, any place you get podcasts. You can hear my happy voice talking about how to keep more of your money in your pocket and working for you instead of wondering what happened at the end of the month. I'm JJ Conway. Y'all take care and be blessed.